I really did want to get some quiet before I introduce Lindsay Gallo, who you haven't met yet, apart from informally. Ryan, of course, was the main instigator of this conference, but Lindsay has done a great deal of work also. And I want to take this opportunity to thank Lindsay as well as to introduce her. Thanks a lot. Lindsay has done a great deal of work in the macro area. It's her area of interest, and primarily what she has done is looking at the interface or the reaction or the correlation between aggregate accounting earnings and macroeconomic outcomes. So this is very much her bailiwick. She was excited about being part of organizing the conference, and you can see that she's done a great job. So without any further ado, I'll introduce Lindsay.
Thank you. Thanks, everyone, for being here. And a special thank you to our panelists who've put a lot of time and effort into tailoring their presentations for our conference. When we began organizing this conference, I was particularly excited to put together a conference on economic forecasting. Not only was I noticing that economic forecasts were showing up more and more in accounting papers, but also recent literature suggests that accounting information might have a role to play in economic forecasting. So this is a very timely a panel for us. So the purpose of this panel is we want to think more about economic forecasts. So what goes into them, how are they generated? And the goal is to not only understand where these forecasts are coming from, but also the potential for accounting inputs into these forecasts. And then even if this conference doesn't convince you that aggregate accounting is the way of the future, perhaps you can find a way to incorporate some of these ideas and methods into firm-level forecasting. So I first want to briefly introduce our panelists. You have their full bios in front of you. So first, we have Claudia Sahm from the Board of Governors of the Federal Reserve, and she's going to talk about using big data to measure consumer spending. She's got some really interesting work using credit card data. And then we have Gabriel Ehrlich from the University of Michigan's research seminar in quantitative economics, which is a forecasting group at the university. And I have to give a special thank you to Gabriel, who's been really helpful to me since the inception of this panel. And he's going to talk about the role of human judgment in forecasting. Then we have Domenico Giannone. I have an Italian last name, but I was very nervous about pronouncing Domenico's last name. He's from the New York Federal Reserve Bank, and he's going to talk about nowcasting. So what is the difference between nowcasting and traditional forecasting and the kind of inputs that are used in his nowcasting models, the New York Fed. And then finally, Eric Geisels from UNC, who's going to talk about a method that he developed called mixed data sampling, which helps to deal with the challenges of incorporating data of different frequencies into forecasting models. And for those of us that have worked with aggregate data, we know that these differing frequencies can definitely be a challenge. And I'm also lucky enough to call Eric a co-author very recently. So basically, we're going to let each panelist have somewhere between 12 and 15 minutes to give their talk, and then I will open the floor to questions. So without further ado, I'd like to welcome Claudia.
So I am excited today to present some work that we have been doing with big data at the board to measure consumer spending. Just a disclaimer, this is staff research. What I'm going to share with you are my views, nothing official here. So I want to start, though, with a little bit of framing. And we hear a lot about big data, and I do think there are a lot of things that we're going to learn about the economy, improve our ability to do macro forecasting, but this is not a free lunch. There are both promise and challenge to using big data. I actually start out here in summarizing remarks that former Fed Chair Janet Yellen gave. So she did a conference at Stanford, gave a speech at Stanford last year, and the first question in the Q&A out of the gate was kind of, so all these innovations in big data, the speed, the detail, are they going to improve macro policy making? Okay, so are we going to learn something here, either as researchers or policy, that's going to actually help the Fed make a decision about what do they do with rates? How do they think about the economy, stabilizing business cycles? So that's kind of, that would be a great goal in terms of doing a better job to help manage the economy. And her answer to this was both there's promise, there is potential here, but we face a lot of challenges before this is really going to be informing macro policy. So on the promise side, businesses, especially now that a lot of electronic transactions are used, businesses create an enormous amount of data just doing their job, like just running their businesses. So that data is being created, and if we can harness that, I mean, it's created anyways just by operating a business, it can potentially give us new information. And this can be important in terms of addressing gaps in official statistics, particularly things about geography or higher frequencies, like daily data as opposed to monthly data. There is interest, and Dennis Fixler mentioned this too, like a lot of the regional, the state level, there's a lot of demand for these data. The idea that we would do this all in official statistics using the standard survey measures, that would be probably both cost prohibitive and it would put a lot of burden on firms and business entities. So if they're creating data anyways by doing business, there's a potential to use that and fill these gaps in statistics. The challenge here is that the official statistics we have, measurement requires theory, not just data. Like you need a structure for putting together national accounts. There's a lot of structure, and they actually go out and create their sampling frames. Like the way they go and get data relates to the theory about what we're trying to measure. This is not how big data is created because it's just businesses doing their thing. So there's not a lot of structure in the data that's sitting around. And that can be problematic, and especially problematic if you have people using big data that don't try to find a way to bring rigor to the data. The other thing, and this is important for any kind of forecasting thinking about business cycles, a lot of these data, they don't exist 20 or 30 years ago. And you need time series to do time series forecasting, right? So we can have, sometimes we'll get into very short time series. They may not be representative of the national economy. So we have to be very careful in doing inference from these data. But there are ways to get around this. So this is a challenge, not insurmountable. Former Chair Yellen mentioned 2 research projects that kind of fit in this, like using big data to try and get at questions that macro policy makers are interested in. I'm very pleased to have been a co-author on one of the 2 papers that she cited. And this is actually, I'm going to be showing you some of the results from a hurricane study, actually Harvey and Irma, that we did last fall. And then, but there's lots of this going on. Like this is a really exciting research area. Actually, the other paper that she mentioned, this has, it's one of these financial apps that people, household level spending, they looked at the gas price changes in 2014. So there's just a ton of interesting research happening here. So we're going to make progress. Okay, so I wanted to say just a little bit about something I've learned in working on these measurement projects is that big data is a big team effort to pull this off and to do it well. So the project that I'm going to show you the results from, this isn't the first time that we tried to go get big data on consumer spending. This is actually the first one that worked pretty well. So having learned from the experiences before, is one thing that's really important is to find a private company who is willing and able to share their data. So you have to find a secure way to do this. You have to probably find an advocate in the company. So those of you that do research and have relationships with firms, I mean, that's really important to being able to do the research, is having that trust and security to do the project. We are very fortunate with this that we are partnering with First Data, which is a large payment processor. They have about $2 trillion of card transactions that they process each year. They are their subsidiaries, so it's a very large company, like 6 million of merchants. So this was very important for us to be able to look at their data and draw inferences about aggregate consumer spending. So it's very important to have them willing to partner in this, especially because we're really trying to create economic statistics. These are more kind of like public good space and not something that's particular to their business practice. Now, so that's a starting point. You have to have access to the data. The other thing that was crucial with this project being successful, and maybe some of the other ones where we had data, but it just didn't come together, is that this is these can be very large processing issues. I mean, we're dealing with we have just every card swipe that goes through a First Data terminal, that's a lot of data. That's more, the Fed, we have lots and lots of data, and it's very empirically driven. I don't want this micro data. Like, this is not something that we want on our servers. This is a lot. So as it turns out, First Data had already had a partnership with Palantir, which is a technology company, who had been helping them organize their data because, I mean, they needed for their own business practices to understand, you know, their footprint and how processes were working. And then the idea was, okay, we have this data, Palantir's kind of organized the data, can we use it to do some kind of economic statistics? So we at the board do not have access to the microdata, but we work closely in partnership with the engineers and computer programmers at Palantir, like how to do the filtering, how to create the statistics. And then what is outputted to us are anonymized, so we don't know merchant identifiers, but we basically end up with daily spending in a geography, so like a state or metropolitan statistical area, and at 4-digit industry code. So we have, and I'll talk a little bit more about this, but that's how the data come to us, and then we use it to do economic analysis. But it is very iterative because we have been able to troubleshoot problems by doing the analysis, going back to the data and the filtering. So this is, just to create these is a big team effort. And then I should underscore that we are fortunate to also be in collaboration with individuals at Census Bureau and Bureau of Economic Analysis, because I talked about it's important to have rigor and like how you do these statistics, and getting feedback from the real experts on this has been crucial. And while I'm going to show you some really interesting results with the big data, none of our indexes would be possible without official statistics. We actually use the economic census as a benchmark, so we grow out levels. So we're going to use big data to get growth rates, get this very high frequency in geography, but we're going to use the economic census because that has a sampling frame. That's representative. You know, so these, what I'm going to show you wouldn't be possible without official statistics. Okay, so just to give you briefly an idea of what we're up against, the chart on the right, that yellow line, that is the raw data. Like if we took all the First Data transactions in this retail stores and restaurants group that we're interested in, you've got like, you know, 150% growth rate back there in 2014. This is very much First Data's business. They were acquiring other merchant or other payment processors. That is not economic growth. That is something very specific to this business. That's something First Data cares deeply about. That is not something I want to put in terms of policymakers. This, you know, I want to strip that out. We go through a whole filtering process, which I'm not going to take time on, but it's basically to kind of come up with a sample that makes sense. And you can see the filtered First Data and the census data, like those are the blue and the green lines. So we're stripping out a bunch of the variation in the raw data because we think it's about the business, not about what's happening in the economy. We go through a filtering process. An important step after that is we validate our data. So on the right, this is showing you the First Data series, and this is after we kind of aggregate up many industry areas, 12-month changes compared to the 12-month change in the comparable Census Bureau retail trade statistic. We have a correlation of 0.9 on these. So this, you know, these are totally different data sources. We wouldn't expect a correlation of 0.1, but that was really important for us to see that where you could compare the two, we were getting very similar responses. So, and then just to give you a sense of what this is durable spending excluding motor vehicles, non-durable spending excluding gasoline, and food services. So that grouping of spending is about a quarter of GDP. So it's an important piece of spending. Okay, so now I'm going to turn to one of our applications of these data. So in addition to having geographic detail, we get these data with a 3-day lag. So what's been, and we're going to hear more about nowcasting. For me, we were tracking Hurricane Harvey and Irma almost in real time and giving updates to the FOMC on this. So for me, last fall was pretty amazing to watch. I mean, I've spent a lot of time as a forecaster thinking about weather effects, and it was pretty amazing to have estimates in hand as I'm still watching the news clips of flooding in Houston. I think one of the things that is important to know this with big data is with it come a lot of responsibility. Like we have very granular data that in some places almost borders on being able to kind of do surveillance on the economy. And so I think being very mindful of what we're working with is important. So I'm going to walk through these results, but this is kind of what we were watching in real time with these two hurricanes. Okay, so not with the fancy graphics in the background, but this is looking at Hurricane Harvey is in red and Hurricane Irma is in blue. What these are our estimates of the effect on national daily spending at retail stores and restaurants during the hurricanes. What this is, the zero is the time it made landfall, and we run a regression that's pulling out the very strong day-of-week effects, month-of-year effects. So, I mean, these lines are smooth. I'm showing you regression coefficients around the hurricane. What you can see here is that on impact with hurricanes, there's a big disruption to spending. So with Harvey, it reduced national daily spending in these categories by 2.5% at landfall. With Irma, the day after landfall, it had decreased national spending by 7.5%. Okay, so different. One was more severe than the other. The thing that's interesting, and one of the questions, weather events are not new. Forecasters have we have methods for trying to think about this and looking through them. One thing that was interesting to us is there's a disruption of spending after the hurricane hits. Spending returns to baseline, so the world in which there was no hurricane, pretty quickly, so within a week. But what you don't see is that lost spending being made up rapidly. So that was something that we had conjectured about and talked about, different categories. Like you wouldn't expect people that were going to go to the restaurant suddenly go like 2 days after, but this had been kind of a debate about when the makeup happens and how rapidly, and we were able to measure it and see it in real time. I wanted to show what you can do in terms of geography. So what I showed you before was our estimates of national spending. This looks at, the top chart is the Miami metro area, and the bottom chart is the Houston metro area for the two hurricanes. So with Hurricane Irma, basically in the Miami metro, retail spending came to a complete halt. Okay, and these are like really big numbers, and kind of, our sanity check backing up these data is that there were massive power outages in the Miami area after the hurricane. These are payment process, if there's no electricity in the grocery store, you're not going to transmit to the payment processor, and you probably don't have your store open either. So I mean, this is part of the data. And you also see differences, for Florida, they had an evacuation order, so you actually see disruption a little bit ahead of landfall. Harvey was much more came out of the blue, and there wasn't an evacuation order, so you don't see the pre-spending. But in both cases, there's not a makeup that's clear in this kind of retail aggregate. Just to show, again, we do all of these estimates at the 4-digit industry code, so we have detailed categories. I'm just showing you two that actually aren't in those national aggregates I was showing you before. Just because of the way we set up the data. But one is with the top is gasoline stations, the bottom is building and material stores. At gasoline stations, it's interesting, you can see the evacuation order with Irma. So gasoline spending popped up when that happened. And with building materials, the one that's interesting with Harvey is that coincides with a Sunday. Sundays are kind of low spending days for building materials stores, but it also was when the floodwaters receded in the Houston area. And so you had people going in and buying their lumber. So this just kind of shows you some of what you can do when you can drill down into the industry. Okay, so I'm on a macro forecasting panel. How do you take these daily data and turn it into something that we would be used to thinking about, like quarterly GDP growth? What we do is just take these daily estimates. We take into account, how many the quarter. Need to take into account that this is only about 25% of GDP. And from all of this, our direct estimate that these two hurricanes shaved off 0.5 percentage point at an annual rate from GDP growth in the third quarter of last year. Now, there's a lot of reasons why this might not be the full estimate of the hurricane's impact. We see a sharp disruption with the hurricane. It could be that the makeup is very gradual and we just don't capture that, so this could be an overstatement. And this excludes a lot of other categories of economic activity. There's a lot of service spending, recreation, there's inventory, and other production sectors that could have been disrupted. And there are just reasons why we may have better geographic coverage than statistics that have a national sampling frame. We just have more power to estimate this. Okay, so just in conclusion, I think there's a lot here, but we're still at the very early stages of harnessing big data, particularly for macro policymaking. The real benefit here is where we can fill in gaps, so that's having this high frequency when there's localized shocks. There's a potential here to not just measure things, but try and think about behavior. And we've spent in our research trying to see what does this tell us about models of consumer spending that might help us improve our forecasting in a broader sense. And then I'll just close with saying, like, I've showed you a lot about big data. I spend a lot of time on this as research, but no data can do it all. Surveys are very important. The group I'm actually in now, we run a household survey, so I spend a lot of time thinking about subjective well-being measures in addition to big data. So you really need to pull together data to answer the question that you have. So thank you.
All right, great. Well, thanks very much for having me, Lindsay and Ryan. So my name is Gabriel Ehrlich. I recently became the director of the Research Seminar in Quantitative Economics at the University of Michigan. And to the best of our knowledge, we are the oldest continuously operating econometric forecasting unit anywhere in the world. So we have a proud tradition of macroeconomic forecasting, and I'm very happy to be able to talk to you about it today. I'm going to be talking about the continued importance of large-scale models in macroeconomic forecasting. And as Lindsay mentioned, it's really going to be a story about the importance of human judgment. So I wanted to just start with a little bit of history of macro forecasting. So the very first macro forecasting model anybody can find is from Jan Tinbergen in 1936. And then there was kind of a dry spell in the macro forecasting literature until the mid-1950s with the advent of the Klein-Goldberger model, which built on Tinbergen's work and was the first macroeconometric model to be simulated on a computer to generate macro forecasts in the mid-1950s. And that work happened at the University of Michigan. And I should say both Tinbergen and Klein went on to win Nobel Prizes in economics for their work. Following the mid-1950s or so, these so-called large-scale econometric models proliferated rapidly. They were all over. And they really came to be dominant in policy making and forecasting in the field. Starting in the mid-1970s, these styles of model started running into serious critiques in the academic literature, and probably people here are somewhat familiar with those critiques. The first was the so-called Lucas critique from 1976, and what Lucas said is that statistical relationships, so models that are estimated purely on statistical data, might turn out to be poor guides to policymaking. Traditionally or historically estimated statistical relationships might not hold up in the face of changes to economic policy. And then the second critique came from Christopher Sims. The most famous paper was published in 1980, but it circulated for a while as a working paper before then. And he said the so-called identifying assumptions in large-scale econometric models are often what he called incredible, that they don't have a really firm basis in economic theory. And he proposed a different kind of methodology for macro forecasting called vector autoregressions, which I presume most people here are familiar with, that involves far fewer assumptions to come up with forecasts. And I should say both Lucas and Sims also won Nobel Prizes for their work in economics. But so a funny thing happened in the last 40 years or so since these critiques were first made, which is that these large-scale macro models never went away. And in fact, they remain absolutely the dominant paradigm among professional forecasters today. That's absolutely true at the government. The Federal Reserve has the FRB US model, which is a semi-structural approach, but does bear a lot of resemblance to kind of the Klein-style models. And then the staff forecast also allows for substantial room for judgment. And then in the private sector also, you still see widespread use of these style of models. And so just to kind of illustrate this, there was a speech by Victor Constancio, who was vice president of the European Central Bank just last September. And he said, "We were just recently faced with the decision of enhancing the multi-country model of the euro area. Which paradigm should we adopt? We have decided to adopt a semi-structural approach. At its core, the new ECB model is designed along the lines of the Federal Reserve's FRB US model." And that certainly warmed our hearts at RSQE. Just for a bit of context, they had been using what's known as a DSGE model as their main forecasting tool, and they decided to put that a little bit on the back burner and focus on a large-scale econometric model as their main forecasting tool. And so my question is, why is it that large-scale macro models have proven so enduring and resilient despite these important theoretical criticisms. And the answer that I've come to in my own work is that they really provide a natural way for economists and analysts to incorporate policy changes and other current events before they show up in the economic data. And so I'm going to discuss this idea in the context of fiscal policy, because that's very much a major player in our forecast right now, and it's in the news. So what I'm going to do is compare various forecasts of real GDP growth. I'm going to take two judgment-based forecasts from individual forecasting groups. The first is the Federal Reserve Board staff, the so-called Teal Book, which is, I think, better known still as the Green Book forecasts. Those are available with a very substantial lag to the public, a 5-year lag. And then I'm going to use our own RSQE forecasts. And then I'm going to compare to what we would call consensus forecasts. So these are averages from a large number of forecasting groups, just like RSQE, and it's known in the literature, it's been shown that kind of forecast averaging will often substantially improve forecast accuracy. But of course, those consensus forecasts couldn't exist without the forecasts of individual groups like RSQEs. And then finally, I'm going to compare to two fairly simple vector autoregression models. The first is a so-called monetary VAR. It includes GDP, two measures of prices, and the federal funds rate. The prices are the GDP deflator and a commodity price index. And then the second is a so-called fiscal VAR, as proposed by Blanchard and Perotti, and it includes government spending, government revenues, and GDP growth. And both of those will be estimated on 4 quarters of past data, so 4 lags. I want to make the point, these are relatively simple models to compare to, but nonetheless, I think it's instructive to compare professional forecasts to these VAR models, both because they've been very influential in the academic literature, and also just because they provide a kind of simple and natural benchmark to compare to. So like I said, I'm going to focus on just forecast errors in real GDP growth from 1 to 4 quarters ahead. I'm mostly going to show you absolute forecast errors, so treating over forecasts and under forecasts symmetrically. But this very first graph I'm going to show you is not. It's just 1 quarter ahead forecast errors for the 6 forecasts I'm going to show you. Obviously, there's a lot happening on this graph. The big thing I want you to take away is that all of these forecast errors are highly correlated with each other. So the 4 professional forecast errors have correlations of roughly 0.9 with each other. The VARs are not quite as close. They have forecasts between about correlations between about 0.7 and 0.8, typically with the professional forecasts. So we have a common data sample from 1982 to 2010. I'm showing you the 1 quarter ahead forecast errors. You can see the blue chip actually does the best, which isn't surprising because it aggregates across a number of individual forecasts. My staff wanted me to show going out more than 1 quarter ahead because RSQE actually wins in some of the extra quarters, but I said, it's too many numbers to put on a table. But what you can see, if you focus on the middle column, which is the root mean squared error of the forecasts, these professional forecasts, the top 4 rows, have errors that are very close to one another. The VARs have substantially larger errors over the forecast period. Again, these are simple models, but it's just something to keep in mind. So like I said, I want to focus on forecast errors surrounding kind of substantial fiscal policy events because that's what's in the news today, and I think it really gets at the point that I want to make. The professional forecasts are the solid lines, so that's RSQE, the Survey of Professional Forecasters, the blue chip, and the Federal Reserve staff, the Teal Book. In the dotted line, I've got the fiscal VAR, and in the dashed line, I have that monetary VAR. I'm mostly going to focus on the fiscal VAR. So this shows forecast errors for forecasts formed in 1987 Q1. So I'm looking at the Tax Reform Act of 1986, or the Reagan tax cuts. That was passed in the 4th quarter of 1986. So we're using forecasts from 1987 Q1 to make sure all of the forecasts had time to incorporate that policy change. And you can just see that the fiscal VAR doesn't really, do as well as the other forecasts. And, our hypothesis about this is it's because it takes time for the effects of tax policy change to show up in the official data, whereas forecasters, human forecasters, can read the legislation and incorporate the effects today. Next, I want to show you the Omnibus Budget Reconciliation Act of 1993. This is the Bill Clinton tax increase. And it's very much the same story. These are forecasts formed in 1993 Q4. The bill was passed in August of 1993. And again, you can just see that especially the fiscal VAR really does a bit worse than the professional forecasters, for similar reasons. And then finally, I wanted to show you the American Recovery and Reinvestment Act of 2009. So this is the fiscal stimulus. These are forecasts formed in 2009 Q2. Again, the stimulus was actually passed in 2009 Q1. Here, actually, the fiscal VAR does pretty well. You can see it's right in line with the professional forecasters. The monetary VAR does a bit worse. But what I wanted to show you is actually in the few quarters leading up to the ARRA. First off, everybody whiffed. Right? So I was talking with somebody who said, everybody wants to do nowcasting now instead of forecasting because in forecasting you always get it wrong, no matter what, right? Whereas nowcasting, at least you've got a shot, right, of getting it right. And so there's no question that everybody, didn't see the recession coming, at least, in consensus-style forecasts. But you can see that the VARs did substantially worse than the professional forecasters. And that was true for forecasts formed in 2008 Q4 as well. The fiscal VAR did pretty well, actually, in 2009 Q1. But again, the monetary VAR whiffed. And again, so I just want to kind of keep banging on this point. Our interpretation of these patterns is that when you look at professional forecasts that come from actual human beings instead of mechanical forecasts, we can actually look at policy changes and incorporate those changes into our forecasts. And I think that's why this style of forecasting has proven so incredibly resilient, even in the face of kind of theoretical challenges to the methodology. And so, the reason I decided to focus on fiscal policy in today's talk is that fiscal policy is a major boost to RSQE's outlook right now. So last year, in November of 2017, we got the Tax Cuts and Jobs Act, which we estimate will contribute about $1.5 trillion in new deficits from 2018 to 2027. That actually does boost our short-run GDP forecast by about 0.2 percentage points in both of 2018 and 2019. And then early this year, we got the Bipartisan Budget Act of 2018 and the associated omnibus spending bill. And that will also, that's basically a substantial fiscal stimulus on the spending side. And that lifted our GDP forecast by about 0.2 points this year, 0.3 points next year, and then 0.1 percentage points in 2020 as the fiscal stimulus starts to fade out. And if I have time, I'll just point out this level of fiscal stimulus in an economy so close to full employment is very unusual. You actually have to go back to the Johnson administration in the 1960s to find this level of fiscal stimulus in an economy that's essentially at full employment. So in any case, here I've got, these are the forecasts that we have current data for. So RSQE, the Survey of Professional Forecasters, and then the two VARs. And what you can see, there's a fairly similar pattern in RSQE and the SPF, which is that GDP growth is expected to be pretty strong in the near term because of this fiscal stimulus, and then starting to fade out as the fiscal stimulus kind of fades away in the forecast. The fiscal VAR actually is calling for pretty strong growth throughout the forecast period, so throughout 2019, and the monetary VAR is basically calling for weak growth through the whole forecast period. And again, our interpretation of that is, the monetary VAR has no way of knowing that there's a fiscal stimulus in the works because it's not in the data right now. So obviously only time will tell who ends up being right, but I thought that this was an interesting way to look at and think about the role of human judgment in macroeconomic forecasting. So thanks very much.
Okay. Thanks to the organizers for having me at this conference. I'm Eric Geisels. The theme of this conference is about firm-level data, firm-level information, and the macroeconomy. That smacks immediately in the face of mixed-frequency data, in the sense that if it's firm-level data, it's financial data. We're thinking about daily data, for instance. If it's accounting data, it's quarterly data, typically. If we think about macro data, we're thinking about monthly data, perhaps, or quarterly. So you see sort of there are these gold bricks out there on this screen, and they say Midas. So that's the Midas touch, I guess. I'm going to talk about more of a methodological talk here about how you deal in simple regression models, for instance, with data sampled at different frequencies. And that's sort of called Midas regressions, actually. I'm going to jump into this immediately with first starting with a macro example, only involving macro data. I'll walk you through how these types of Midas regressions work. Then I'll talk a little bit about accounting application applications, again, still using time series data, actually. And then, towards the end of my talk, I'm actually going to talk about firm-level cross-sectional data and aggregation of that and use of that, and projecting or expanding some of the Midas regression ideas that have been around for a while now in the time series context to cross-sectional settings. So how do we deal with that? The latter part of my talk actually is joint work with Lindsay and Ryan, so I'll talk about that. So as you see here on the screen, there is sort of a time scale, quarterly, monthly, daily data, and it lists a number of series that are respectively sampled at quarterly, monthly, and the daily frequency. I'm going to focus on market returns as my daily toy example of daily data, and GDP growth as my toy example for quarterly data. And I'm interested in forecasting GDP growth using high-frequency data. That's just a toy example. Claudia talked today about, earlier in this talk, about measures of spending that were daily, but ultimately also wants to project that on low frequency. That would be another example of that. How can we actually use this high-frequency data in a regression format? So the Midas regression format has advantages that it is actually a relatively simple format, framework. When you talk about regressions, these are the first things that we actually teach to our students when you talk about statistical analysis. What is also nice about it is that these regressions can actually, the regression format can easily be extended to logistic regressions, quantile regressions, vector autoregressive models with mixed frequency data, so it's kind of relatively easy. It's also relatively simpler to the sort of more structural models of factor models that Domenico were talking about. They're both advantages and disadvantages. One of the things that Domenico really emphasized was the combination of flexibility and parsimony. That is the thing that is going to be driving us in this conversation as well, actually, the very same issue. So I'm going to focus on a very simple regression model where I predict GDP growth in QT plus 1 using lagged GDP growth, the famous autoregressive model of order 1. And I'm going to augment it with daily data of stock market returns, say the S&P 500 for the sake of argument. You can see that there is a 63 out here. That's just the number of trading days, just for the sake of argument. And the D stands for the days, and that's the day of the quarter, QD. And each of these days have a weight. And you see there is the balancing act between parsimony and flexibility at the bottom of the slide. And indeed, one way to deal with this, which is very common, is to just say, I'm going to compute some quarterly measure of stock market returns, for instance, the equally weighted average. That aligns the frequencies, fine. That also aligns, that simplifies the number of parameters. I'm not even dealing with these weights in this regression. I don't treat them as parameters. That's one extreme. The other extreme is I'm going to blast a simple OLS regression off and have an estimation of all these weights. They are restricted to add up to 1 just to estimate beta as well. So that really drowns you in parameters, and that's going to be really not a good idea. At the bottom here, if you can read, there are about 65 parameters in that regression, and that's a little bit abusive, actually. So the thing that strikes the balance between the two is to say, look, I'm not going to estimate these individual weights. I'm going to sort of estimate them as a function of some smaller set of parameters. They're sometimes called hyperparameters in this technical jargon. So instead of estimating each individual component, I'm down to estimating the weights, but only with a few parameters. So I'm taking advantage of the high-frequency data without being drawn into estimating a lot of parameters. And the logic here is perhaps equally weighting tells you that all days are equally weighted. Perhaps that's not the right idea about thinking about forecasting. In a time series context, perhaps the most recent information is more important than the distant information. So an example of this would be if I take an exponential function, and that involves just one parameter. In that case, we only have 4 parameters in this regression, as opposed to the 65 that we had earlier. And depending on how you choose this parameter, you can actually have either very fast memory decay, and only this scale goes from 63 all the way back, so it kind of goes backwards. You have to think first of all, this is the last day of the quarter, and then goes to the first day of the quarter. And so you kind of downweight either slow or fast. And equal to 0 is flat weights, which is equally weighted, actually. So you can actually think about equal weights as a special case. Now, that pattern is a little bit perhaps too restrictive. So you might expand your class of functions or weighting schemes that you look at. And here is just an example where you do a quadratic version of it, where you can get non-monotone patterns in terms of the weights. So this landscape of MIDAS applications has been quite extensive now in mostly the macro forecasting literature. I have to say that I'm going to do shameless self-serving advertising. Namely, it started out with some of my work a while ago, notably work with Peter Sendeklar and Ross Valkanoff. Clemens and Galgao did it. Some earlier work as well in this area. But then there's been so many applications, and this is the advertising. There is a book that just came out in 2018, April, with Massimiliano Mercellino, and it has an entire chapter on forecasting with mixed frequency data. So rather than list a lot of papers, this is the advertising part. Now, this isn't a conference for accountants. I'd like to point out that the 2 organizers of this conference actually have exploited more the relationship between accounting data and financial data in a MIDAS framework. And Ryan Ball has actually also co-authored a paper on this with me. And actually, if you have any questions about MIDAS regressions and accounting, I am not the accountant. Ryan knows much more about this topic than I do. Now, you see that there is the word firm written on these slides as well. And what I'm going to do in the last part of this presentation is present some new work where the idea of MIDAS regressions is now expanded to cross-sectional issues. As I mentioned earlier, this is joint work with Lindsay and Ryan. And the idea is basically the same in spirit. The idea of MIDAS regression is we solve the parsimony, the fact that we deal with a lot of data with just a hyperparameterized convenience scheme that will give us weights across large sets of data. Now, time series has the feature that there is a natural order in the sense that time progresses through in a natural order. For cross-sectional data, that is not perhaps such an obvious thing. You have not such a natural thing to do. Can we hyperparameterize weighting schemes that are similar and that work in cross-sections? So this is sort of the challenge that I'm going to end the talk with. I'm going to focus on earnings data in the cross-section. So we're not talking about time series anymore, but we're still talking about having large data sets here and focusing on forecasting GDP growth. The regression I'm going to look at is very similar in spirit to the one that I showed with time series predictions for high-frequency or daily stock returns. But in this case, I'm going to look at a cross-section of earnings data as prediction for GDP growth. And like in the time series regression, not every day is getting a separate weight, but every firm is getting a separate weight in the cross-section. That's the thing. Now, I started in the sort of parsimony case with like a benchmark model, which was equally weighted. So here, I'm actually going to start from a benchmark model as well. And then, as the title of this talk says, I'm going to tilt the weights away from the benchmark model based on some characteristic that will be, in this case, earnings smoothing. That's going to be the characteristic that I'm going to use. So let's go through this. First of all, this is a large data set. These are large cross-sections, more than 1,000 firms per quarter. The benchmark is, we happen to take a convex combination of equally weighted and value-weighted schemes. So that is very much an often used benchmark in the accounting literature. Now, the tilt component, and that's the real innovation, and that is the thing that really similar to Midas in the sense that we're going to just try to reshuffle the weights around in a parametric scheme. By the way, all the way through, everything is parametric. So we can start doing hypothesis testing the way we always do like hypothesis testing in regressions. There's nothing really special about it. So we'll talk about, is this beta coefficient that is in front of that, is that significant? Is this tilt coefficient that I'm going to be talking about, is that significant, for instance? That's just standard hypothesis testing. So this is basically tilting the weights away from the benchmark. And in this case, the information that is being used to sort of discriminate in the cross-section, put more weight on firms that have more information versus less, is going the smoothness of the earnings. And that's going to be, we call that the tilt component, and it tilts you away from the benchmark. So you can estimate that and do something about it. So here is a toy example of this, how this works in the context of cross-sectional earnings, using the smoothness as an indicator. First of all, that tilt parameter that puts you away from the benchmark is highly significant. It's 0.70 with a standard error of 0.91. So it's highly significant. That's number one. And then when we're interested in the impact of earnings information on aggregate low-frequency GDP growth, then we're looking, the left number, the 1.19, that's the one that you get if you take your benchmark weighting scheme. You just take either a value-weighted or equally weighted or some convex combination of that. The coefficient to the right is 4.6, and incidentally, that left, the one on the left is not significant. The one on the right is the one that is the one with the tilting towards the smooth earnings series, putting more weight on them actually in the cross-section. And that is highly significant, that beta coefficient. You also see the increase in the adjusted R-squares. It's just the tip of the iceberg. Both in the time series, there's a lot of work already in mixed frequency, but also in the cross-section. Thank you. It's the Midas touch.
So we have time to take a few questions.
I had a question for Gabriel. I guess first, thanks to all the presenters. They were all really interesting presentations. With respect to the professional macro forecast, at the firm level for corporate earnings forecasts, we have this literature on systematic forecast errors made by professionals and how you could improve forecasts by correcting for those. Do you have a similar literature at the macro level, and do you have, or if not, do you have an opinion about? You said everybody gets the same thing wrong. What are some of the systematic errors?
Well, thanks for the question. I don't know that literature particularly well. I shouldn't say everybody gets the same thing wrong. I mean, there is meaningful variation in the forecasts, but the reality is that using kind of that straightforward auto-regressive model, you're going to match. If GDP has been growing quickly, the forecasters are typically going to say it's going to grow quickly this quarter. And if GDP has been growing slowly, the forecasters are basically going to say it's going to grow slowly this quarter. There is a lot of kind of trend extrapolation in forecasting. And so it shouldn't be surprising in some sense that then when you get a shock to GDP, that you tend to see, most forecasting methodologies miss the same direction. So I don't know if it's about bias per se. I did have statistics about, the bias in the forecast errors. So, for the professional forecasters, they tended to be in the sample I showed you, which was kind of 30 years from the early 80s to 2010. The professional forecasts typically called for GDP growth to be about 0.3 percentage points faster than it typically was, whereas the VARs, so the fiscal VAR was actually right on, so it basically had very little bias, but a lot of variance, and the monetary VAR had actually the opposite sign and a bigger bias than the professional forecasts.
So this is a question for many of you, actually. It seems to me that those distributions and forecast errors and confidence intervals were large. And there are clearly business decisions and all sorts of policy decisions being made off a summary statistic. How representative, aren't you uncomfortable that the uncertainty is actually the bigger issue, or the variation? And some of those spikes were enormous. Isn't that where, we go back to some of what Dick was talking about, it's the tails that matter. It's not the mean or median.
The macro forecasts that we've been showing, or the Nowcast, these are inputs to a decision-making process. So, there's discussion about, say, just in the example of monetary policy, there's discussions about discretionary rules, like using a Taylor rule. Something like that would be very transparent for determining how to set interest rates. Your point is very well taken that you have to be careful about what you would put into a rule like that. So I think the fact that the policy-making decisions that we see for macroeconomic policy, there's a judgment piece on the part of policymakers, and part of that is because these inputs are uncertain. And so one of the things at the board, when we present the staff forecast to the FOMC, there are charts that very clearly show what are the dispersion of our forecast errors and how big are the uncertainty. And to the nowcasting points, that uncertainty, when you're forecasting far out, no one can do 2 years ahead. But even in kind of knowing the present, as the data is coming out, you learn more and more. And then part of the reason I think even you see systematic errors is sometimes it takes a while for the macro data, the official counts, to catch up with reality. That was certainly something we saw in the Great Recession. It became much worse years later, looking back. But I think that's why you have to know how to use these kind of estimates when you're trying to make decisions.
Can I perhaps a little bit more a general point about this is that we have a tendency to actually model the mean or the conditional mean and then build confidence intervals around that. Now, it turns out that over the last few years, macroeconomists have sort of realized that what determines the downside risk is not necessarily what also is on the upper side, the variables that enter there. So you're talking about, on the one hand, models for the mean. Take, for instance, inflation risk. At the bottom, the downside risk is more perhaps monetary policy. On the upper side is more, say, oil prices. And so we have a tendency to think about these symmetric confidence intervals as just building a model for the mean and just have a standard error and then just build that around. A much more deeper question, and when it comes to quantile regression, for instance, which is looking at particular tail behavior specifically, either upper or left tail, right or left tail. And I think that is a much more interesting way to go than thinking about uncertainty as a symmetric measure just around that mean. I think that's more, and people in finance have already figured that out for a long time, a little bit more in terms of downside risk models. It's sort of now getting into mainstream macro forecasting.
If I can just add one last, at the risk of becoming political, I think you raise an interesting and important issue, and some of the responses have touched on just the measurement component and the difficulty just measuring what GDP is doing. And one point I want to make is economic measurement and statistics are a true public good, in theory, they're essentially non-excludable and non-rival. And the government really has not funded this activity at maybe the levels one might hope. So, the role that you can play if you want, better forecasts and better statistics is when, if you talk to policymakers, is just emphasizing, you said that these are important inputs into decision making, and really making that case when you get the chance, because it's, I don't think that argument is universally accepted. So if you value it and you're talking to policymakers, let them know.
That's a good note to end on. That's all the time we have for this panel. Please join me in thanking our panelists.